Good morning, Jags. This is Fahad. Today is Wednesday, March 10th. Let's get started. Going to bring a cannabis stock to attention this morning. The company is called AYR Wellness, symbol AYRWF. This is a five-letter ticker, AYRWF. This company will be reporting earnings tomorrow, March 11th, before market opens at 8:30 in the morning tomorrow. And I'm expecting the company to provide pretty strong guidance. I don't think the Q4 earnings report is going to matter as much. There's a lot of moving parts, which I will discuss shortly, but it is the guidance where I expect they're going to be very, very positive about that. So I expect the stock to respond positively with a breakout. Now, I don't think this has any kind of option activity. Let me just check once again. Yep, it does not have any options. The chart has held up rather very, very nicely during this market correction phase that we just went through. As you can see, consolidating between 30 and 34. And it just yesterday started to break out through this downtrending resistance, which is right over here, and the volume surge behind this as well. MACD has corrected slightly, and we're going to start to see a bull cross, and RSI has started to lift higher. Now, with all of this said, AYRLNAS is a producer of marijuana for both medicinal and recreational purposes. This is a $1.8 billion company that has a very strong path to growth. So for example, if I show you, this is what the revenue projections look like going forward, each quarter going forward from here. And this is what the EBITDA projections look like. Let's put both of these charts together one by one so you could have them on the screen. So here's that, and here is this. This is the revenue, and this is the EBITDA. The question is, for each quarter, they're expecting this ramp higher, not only EBITDA margins going higher, but also the absolute number extrapolating or rising sharply. Same thing with revenues. How are they going to get there? They're going to get there with tremendous number of very good quality, high quality acquisitions that the company has done quietly in the past 3 months that are just going to start to come into the picture. On January 20th, I read a very interesting note from an analyst, and I saved it at that point. And this analyst made the case that, for example, if you look at just in the state of Florida, you will find out that the penetration for medicinal marijuana use in the state of Florida is rather very low. There are currently 465,000 patients in the state of Florida, which represents only 2.2% of the population, which is currently not even fully penetrated. Compare that to the state like, for example, Pennsylvania at 3%, Arizona at 4%, and Oklahoma at 7%. Remember, Florida legalization only happened very recently. So there's as much as catch up, significant amount of catch up to do in just in the state of Florida to catch up with the rest of the states. But this is not just about the state of Florida. If you look at the news flow in this stock recently, and these are not all the press releases that we have seen either. There's a lot more that's out there. On December 23rd, this company announced an acquisition of Cantac in Pennsylvania, which is an acquisition to grow in that state after the legalization. Similarly, on right here on February 24th, this company announced a second opening of a dispensary in the state of Pennsylvania. This happened on February 24th, very recently. And then also on February 26th, 2 days later, this company announced that they're closing on an acquisition of Liberty Health Sciences, which is a pretty solid and pretty well-established company with presence in many different states. So this is going to give them penetration in Florida. This company has a huge presence in Florida as well as in a few other states as well. And then also they announced this on March 1st that they are going to open their third Las Vegas dispensary in the state of Nevada. So they continue to push in the areas where there are high growth markets. Again, I just showed you 4 of the press releases, 3 of which came out just in the last 2 weeks, all about acquisitions One press release came out from December, and this is not even all. If you Google search it or if you go to company's website, you will find out that there's a ton more small tuck-in acquisitions that the company has done. This is the company's website where you can go and read all about it, all the cannabis industry and all the locations they have. If you go here, for example, you'll be able to see they're in Massachusetts, they're in Nevada, they're in Pennsylvania, and many other places. And the recent acquisition that they did in Florida will also get listed on its website rather pretty soon. That was closed on March 1st. So the company continues to move in the right direction, and that's why this growth trajectory for revenues and EBITDA looks like. How high can they go in terms of their revenues? Well, for the fiscal year 2020, which will be reported tomorrow morning at 8:30, this company will likely show their total revenues of about 155 million. For the fiscal year 2021, those revenues are expected to climb to $410 million. That's a growth rate of about 140% year over year. At that particular point, if you base it off the fiscal year 2021 estimates with a growth rate of triple-digit percentage, with a $1.8 billion in market capitalization, this company is trading at about 4.2 times sales versus the industry currently is trading at 9 times sales, making the case the stock is extremely cheap on forward-looking basis, as much as half the value perhaps than where it should be compared to peers. And on top of it, the profitability is significantly improving, with not only EBITDA rising as sales go up, but also margins rising because they get the economies of scale along with it. There's also a belief out there, particularly by Needham analysts, which is out with a note this morning as well, that at this rate, because all these acquisitions will be incorporated completely, and then a few more tuck-in acquisitions, such as in the state of New Jersey, has yet to come in, as well as in Michigan, we could be looking at a company that will likely produce total revenues of about $700 to $750 million in fiscal year 2022, which means the stock is trading at only 2.5 times fiscal year 2022 sales, making it extremely cheap compared to peers, almost at 25% of the value where the peers are trading, with a growth rate that is far, far superior than the rest of the industry. One thing I will just quickly also highlight real quick is just to touch upon a couple different states where they have recently done these acquisitions. So for example, in the state of Massachusetts, they expect 3 adult use locations to open in the greater Boston area in fiscal year 2021. That has not come into the picture yet. 1 will be co-located and 2 will be for the adult use. In the state of Massachusetts, they expect adult use dispensaries to average $16 million in annual revenues, and from there going to take a parabolic move higher. Moving on to the state of Pennsylvania. Revenues will be initially driven by the 3 dispensaries that they have currently. One of them opened in the month of February alone, and the 3rd location is going to open before the end of March. So again, this is all happening in real time. It's all current, as that's why future growth looks so strong. Moving on to state of Florida, the Florida acquisition closed in late February. Once again, that goes back to my point why Q4 earnings report is not going to tell you anything. It's all about the outlook, because this huge Florida acquisition closed at the end of February. The asset will be a work in progress with the dispensary revenues in Florida, but gradually they expect this growth rate to extrapolate and expand sharply from these acquisitions. In the state of Arizona, they have three medical dispensaries to operate at an annual run rate of $12 million, and that's going to ramp higher to $18 million over the course of the entire year. Again, these acquisitions in Arizona were closed in late January. Additionally, in the state of Arizona, planned expansions are in play for more acquisitions, as well as more new opening of dispensaries. In the state of New Jersey, revenues will be driven by 3 operational dispensaries, and with a 75,000 square foot cultivation expansion plant, which is also currently under development, versus currently they only have a 30,000 square foot facility that they're operating right now. And lastly, in the state of Ohio, AYR will have an operational processing facility once the acquisition closes. That's expected to happen in early April. And then from there, growth rate will ramp higher. So there you go. Again, New Jersey is still open, Michigan is still open, and many other states are still open as well for market grab. So this is what these charts look like. Going back to what the actual technical picture looks like, I expect management is going to be very, very upbeat about the outlook given all these acquisitions, and there should be. Let's see if the stock reacts with a breakout. That's it from me. Let's go to Jay.
Morning, everyone. Just some quick medtech discussion today. First off, very quickly, since it was covered last week by you, Fahad, B of A is upgrading Pulmonx this morning, ticker LUNG. They go from neutral to buy, $72 price target. They ultimately see 100% upside potential to consensus estimates in 2022, but they also see strong signs of emerging momentum, and that's really based on what they saw in the last earnings report, which you covered last week. So we just wanted to throw that out there really quickly.
Yep, sounds good. I did see that upgrade from Bank of America, and the stock is quite oversold here, frankly. This is also a major VOP support level at $50 per share. I think a lot of the growth of stock just got hammered for all the wrong reasons during this market correction, and this is one of them.
Yep. And the other med tech is Outset Medical, ticker OM. I'd say between Pulmonx and Outset, I think these were two of the most requested names within the last month and a half to take a look at. Unfortunately, these two really don't get a whole lot of intra-quarter channel checks, so it was tough to really, give clients an idea ahead of earnings. But anyway, Outset Medical was a name that I covered back on November 29th in Weekend Research. And it was bad timing. Stock has not performed since, but stock is up 9% today after it reported earnings after the bell yesterday. So for those that do not know, this is a medtech platform developing and marketing the Tableau hemodialysis system. Some takeaways from the call: total revenue exceeded expectations. They reported 17.2 million in total revenue, which was up 143% year over year and 25% sequentially. Console orders for their Tableau system also exceeded their forecast. They exited 2020 with approximately 550 consoles in the backlog. They ended the year with a total of 1,100 Tableaus in the field, of which roughly 900 were in the acute setting, 100 in the subacute setting, and 100 in clinics and homes. They also signed new agreements with regional health systems. So as a result, they are now partnered with approximately 20 of the top 50 regional health systems, as well as 6 of the top 8 national health systems. Now, if you look at Weekend Research, I talked about the industry, but then I talked about two segments: the acute setting, which is their biggest segment right now, but also the home segment. And on the conference call, CEO Leslie Trigg, did talk about this specific segment, saying that another exciting development for us in 2020 was receiving FDA clearance for the use of Tableau in the home. Now, looking ahead to potential home upside, CMS established a new program called TPNIES, which stands for the Transitional Add-on Payment Adjustment for New and Innovative Equipment and Supply. This was implemented by CMS in 2020 to encourage dialysis providers to adopt new technology. In 2021, the program was expanded to include new capital equipment for home dialysis. So the company said they recently submitted an application on the basis of the Tableau console to the CMS. And they say, while a positive response from CMS would represent another tailwind for Outset, receiving approval is not yet included in our current forecast. Additionally, if they're not granted approval this year, they have the ability to reapply in 2022. And regardless if they are successful in either year, providers would receive incremental reimbursement for Tableau home treatment based on the rates to be determined by the CMS. So the home segment is still very small, but as we can see, there are potential tailwinds that could happen in 2021.
Yeah, and that was exactly the message in the weekend research. When right here's a snapshot for that, or this is the actual weekend research from November 29th, in which this Outset Medical was discussed. A very interesting and a very promising company with not only home market disruption, but also in acute care in medical facilities. And then a very, very strong earnings growth has been emerging. Last quarter earnings report, before this one that just came out, up 423% year over year. Product revenues up 349% year over year. So I have fielded a lot of client questions about this too with emails that pop up. Many people love that research note, Jay, from you back on November. And I know firsthand that with the text messages that I received this morning from a few clients that they're positioned in this one. So the stock is going to gap higher by about 9% this morning after this fabulous quarter. And I think on the long term, this picture that you have about the home market disruption remains the key. And the question remains how much of the penetration we're going to see of this dialysis Tableau software or the machine for home use. Right? I mean, I don't think there's much competition in this space. And so that's going to be one to watch. Long-term winner, definitely a hold in my view. And I think this thing is going to eventually return back to new 52-week high. Great quarter, great company. All right, let's go to Chronicle.
Morning. Today I'd like to talk about XPEL earnings, which is expected to take place tomorrow before the open. So this is really my last chance to give a preview. This company remains one of my top 3 highest conviction plays. I'm still holding a core position, which I've had since low 20s. And
hey, sorry, Chronicle, can I stop you there just for a second?
Sure.
Talent just got acquired for $52 for $2.4 billion deal, actually for $66 per share by Thomas Bravo. You know where I'm leading with this. This one, Talent. I think there was a discussion about this previously as well. But anyways, I'm going to move on. But a very nice acquisition. I think I know some clients that are going to be excited about this that just got acquired. Anyways, go forward. Sorry about that.
Sure. So now going into this earnings report, honestly, we're already in March, so I don't think the market's going to care too much about what the company reports for Q4, but rather I think the bulk of the emphasis is going to be on the 2021 outlook and forward-looking commentary in the conference call, as well as details about expansion plans in terms of both geography and secondary markets. So first of all, this entire recent sell-off with rates going higher, it's mostly to do with how the street and buy side are using discounted cash flow models, typically for between 5 to 10 years. And when they start inputting 1.5 or even 2% risk-free rates, as opposed to 0, then when they start discounting all of that future value and cash flows back to present, then obviously the forward discounted values for a lot of growth and unprofitable companies are going to look much worse than with rates at 0 because of the compounding effect. But that said, I do think the sell-off has been getting overdone, especially with XPEL, which has been unfairly lumped together with the momentum basket. Because if we look at XPEL's financials, first of all, the company only has about $12 million of debt versus $27 million of cash on its balance sheet. So rates can go higher for all we care, and it's not going to affect debt repayments all that much. Secondly, as we've stressed in the past, XPEL is not a loss-making company. Not only has it been growing sales, it's also been growing earnings on the back of expanding gross margin for all the reasons we've already laid out. Like if we look at these 4 graphs, it doesn't make sense why the market was violently selling the stock. Like even if we were to input 2% or 3% interest rates into a DCF model, the present value is not going to look all that much worse, precisely because of how efficiently this company prints money. I can completely understand why other momentum stocks sold off, but with XPEL, the only reason I can think of is the perceived expensive valuation of the stock. And even then, I think that's that it's only expensive on the wrong numbers, which brings us to why I believe current sales and earnings estimates for fiscal year 21 are too low. First of all, I think the street is being too conservative with the growth of automobile sales and recovery of mobility all around Asia Pacific. XPEL's products tends to be popular with electric vehicles. And meanwhile, I live here in Asia and I'm starting to see cars everywhere, even at 3 p.m. on a weekday when people are supposed to be at work and there's not supposed to be any traffic. So in terms of mobility on the roads, we are looking even busier here than before the pandemic. And if we look at what XPEL management said in the last conference call, CEO Ryan Pape is expecting their ongoing shipment and inventory delays in China to begin easing towards Q2. So the company should be able to better capture the demand recovery in this part of the world once they get over that hump. So I think this is one area to be looking out for in this upcoming conference call. Meanwhile, looking at Europe, especially with the company's operations and expansion plans into France and the UK, logically, those regions should also start to see an improvement as these countries come out of lockdowns. And then for North America, when I look at the forward-looking commentary from the recent earnings call transcripts of companies like Advance Auto Parts and O'Reilly Automotive, the managements of those companies have said they are seeing particular strength within the discretionary aftermarket appearance products, which is exactly the category that XPEL serves. And then on top of that, XPEL also announced a couple months ago that they acquired a Texas-based architectural film company called Veloci. So this is another step that XPEL is taking to grow their side markets. I think this will see some sort of benefit when the demand for offices and commercial spaces start to come back. And presumably this was funded with cash, which is the normal practice for this company. So putting everything together, honestly, I think every geographic segment is going to come in strong for fiscal year 21, except for Latin America and Africa, because those regions were never had a fair shot at securing enough vaccines. And at the moment, Fahad, consensus is only expecting $184 million in sales for 2021. In contrast, I think we are going to see above 200 million for this year, which would imply at least 29% growth versus 20% last year. And to be exact, I have $202 million in my model, even after accounting for supply chain issues. So I think there's a big disconnect here with regards to the sales estimates. And as for EPS, I currently have 85 cents versus consensus 76 cents, which is exactly why I said the forward PE ratio for the stock is currently off. Like this stock only looks expensive on the wrong numbers.
Yeah, very good earnings preview here, folks. Just a reminder, once again, XPEL will be reporting earnings tomorrow, March 11, before market opens, and Chronicle just gave you his preview, a name that has been a fabulous, fabulous winner for a lot of us, including myself, I have to say. Chart looks good, looking for a breakout over here. And Chronicle believes that fiscal year 2021 revenues based on his own models and assumptions will be around $202 million versus $184 million street estimate, and earnings per share to rise to 85 cents versus 76 cents estimate. And so there is a major disconnect between street expectations and Jaguar expectations. And just a reminder once again to everybody that in Jaguar Media, back on October 9th, is when we presented this bull case in the investing series that time. And so a big 20-minute presentation was done purely dedicated to this stock, a name that nobody cares to talk about. And this was on October 29. You can see when October 29, what October 29 was right here. Literally within 2 days after that presentation, the stock started to break out from 25, rising all the way to 60. More than doubling in the course of just 3-month period after this presentation was made in Jaguar Media. Then it went to a 2-month-long consolidation and now setting up for another breakout. I'm looking forward to the quality earnings report that the company will report tomorrow. Great stuff, Chronicle, as usual. All right, folks, thanks for joining. We'll see you in the chat room shortly.